bottom of the market or invest in a rising one? Hey everyone, I'm AJ, Director of Handle Properties, where we help Aussie investors build serious wealth through property investment. Since launching in 2023, we've purchased over 80 properties and our clients have enjoyed a cash on cash return of over 50% within year one of investment. Watch to the end of this video if you want to get our take on whether you should invest in a rising market or one that's just about to start moving. And better yet, we'll give away some of the key metrics that we look at Handle Properties to make sure that we're timing the market correctly for our clients. Let's first start by debunking the age-old question of, do you invest at the start of a cycle or the end of one? Or rather the first idea, which timing the market itself is impossible. Unlike the stock market, property market doesn't fluctuate 1 or 2% intraday. Why? Well, property is a slow-moving investment choice. Think of it like this. You decide to purchase a property tomorrow. What do you need to do? You need to go get a pre-approval. That takes a few weeks. Then you need to source properties, search them, go to open homes, put in offers, and then there's that lengthy time to settlement. But you might be thinking, steady, guys, property always goes up. What are you talking about? This simply isn't true. If you pull up this chart here, you can see that each capital city in Australia has its time in the sun. In fact, growth in the property market, particularly in Australian property, happens in cumulative chunk-sized pieces that often last anywhere between 5 to 10 years. Now, the interesting part here is growth is actually condensed within this period, and then you see long periods of no movement at all. As a property investor, your job is to make sure that you invest in the growth times and not in those lull moments where your investment might be sitting idle, not generating returns for you. So, with that out of the way, you can very clearly see from this chart alone that timing the market and investing in one of these cycles where growth is going to happen for the next 5-10 years is the way to build significant equity into your investment property. So, that then brings us to the next question. Let's use this knowledge about growth cycles in an Australian property to understand whether or not we should time the market. Okay, well, if you're only going to buy one property, you might be thinking, who cares about timing the market perfectly? Like, I just want to buy in a market where the returns are going to be great in the long run and the short term is okay. Now, this sounds like it makes a lot of sense, but the risk is, as we saw in the chart above, if you time that market incorrectly, your investment might be sitting idle for 1, 2, 3 years. That's 3 years of you being able to generate returns that are significant in another area. But let's run through a scenario as well. Let's say your approach is to buy in a slow market, which you think will move upwards. You purchase a property in today's market value of $500,000. You pay a 20% deposit, the interest rate is 6%, and your rental yield is 5%. So you might actually make a total rental yield of this investment of $25,000. So that's 5% of the 500. But then you have property management fees, you have council rates, insurance, and other costs. So really, you'd be very, very, very lucky to make $20,000 back in pocket. But if the interest rate's at 6%, your loan of $400,000 after that 20% deposit is still costing you $24,000 every year to hold. That means you're making a loss of $4,000. Now, while it sounds okay, like $4,000 to hold a property, is it really that bad? But when you put it down to the basics, you are literally holding an investment that costs you money. So if that property is not growing at least 1, 2, or 3% every year, even after equity growth, you might be losing some money. Now, I don't know about you guys, but to me, losing money doesn't sound like a sound investment decision. And then there's a second added risk. If you're not making that growth in the property, you might actually go ahead and lose that $4,000, $5,000, $6,000 every year for the next 2 to 3 years. That's a lot of money to park away in an investment that you're unsure about when it'll actually move. Let's now assume you're the same investor, but you take a different approach. You don't care about timing the perfect entry into the market, but you rather want to invest in a market that's already gotten runs on the board and is showing excellent growth. Of course, we don't want to invest in the late part of the cycle. We've got some metrics on how we look for that, which we'll talk about later on in the video. Same exercise. You've invested $500,000, 20% deposit, 6% interest rate, except the only difference here is this property is now growing over 10% year on year. Sounds crazy, but many of our investors are achieving these kind of results within a year, if not within 6 months. So it's definitely doable in today's property market. In this scenario, you have made an equity gain of $50,000. Even if you lose $4,000, $5,000, or $6,000 to hold the property, overall, your investment has grown by a considerable amount. Let's call it $4,000 loss, $50,000 gain. That's a gain of $46,000. And your initial deposit was only $100,000. So that's 46% return that you could have banked within a year. Now, if you play that forward another year, it could be closer to $100,000. The benefit of this approach is even though you might not get a full 5 or 10 year cycle, you have built considerable equity quickly. That's equity that you can then extract to purchase your next investment and start compounding your returns and building your portfolio quite quickly. We look for these kind of high growth suburbs for our investors. We're okay to miss the first 6 months or 12 months of growth. What we want to do is make sure that they're not stuck with their money in an investment that goes nowhere. Instead, we want to see considerable returns in the short term so then our investors can actually extract those funds to purchase the next properties. And we look at a lot of different data factors to give us confidence around this. Things that we look at are, has the median price moved over the last 12 months? What's the stock on market? What are the vacancy rates? How long is it taking for a property to sell today versus 12 months ago? Or perhaps what's the rent today versus 12 months ago? And we consider a lot of these change analysis to get a good understanding of whether this market is actually moving faster today than it was yesterday. And the final thing we overlay on it is we check for historical 10-year growth rate. If the suburb has already grown 15% in the last 10 years, it's unlikely that it's going to continue on that trajectory. In fact, we actually take a contrarian view here. We want a suburb that's underperformed the national average in the shorter period of time, but is now demonstrating accelerating growth patterns. This means that it's actually got a lot of catch up to do, and by looking at the data, we can see there's enough fuel in the tank for this suburb to actually get there. Through this kind of approach, we've been able to generate significant returns for our investors who are now into purchasing multiple properties. So if you're serious about building a passive income stream that's going to get you to financial freedom, or to help you and your family escape the rat race, reach out to Handle Properties today and let us take you through our approach to property investment.